Good afternoon, everyone, and welcome to today's OIC presentation on theoretical options pricing. I want to thank each and every one of you for taking time out of your busy schedules today to be with us. I think today's presentation is going to be really interesting, and I hope you get a lot out of it. My name is Ken Keating, and I am the newest instructor here at the OIC. However, I am certainly not new to options. I've been involved in the options industry for over 25 years, both on the trading side as well as the analysis side. To give you a little background on myself, I started out as a market maker in the early 90s on the Pacific Coast Stock Exchange out in San Francisco, working for one of the largest privately held independent market making firms. I then moved to Chicago, where I worked as a floor market maker as well as a floor specialist. I moved back to San Francisco, where I oversaw risk management for my company, as well as running off a large off-floor volatility arbitrage desk. After leaving my company after about 15 years, I moved to a capital management company where I also managed and ran an off-floor vol arb book. In addition, I worked for myself as a sole proprietor and remote market maker on the CBOE, and through the wonders of technology, I was quoting markets remotely from my office in California into the Chicago Board of Options Exchange. So I did that for about 3 years, and then after 20 plus years in the business on the trading side, I left the trading side and transitioned to the analysis side of the business, where I worked for 2 startups analyzing equity and derivative flows for publicly traded companies. So essentially, I've worn many different hats within the options industry. And the hat I currently wear is with the Options Industry Council, the OIC, working on our investor services team, helping investors such as yourselves to better understand options and options strategy. So before we get started, there's just a couple things we have to go over. Have to talk about the disclaimer. Options involve risk and are not suitable for everyone. I recommend that everyone read and understand the risk disclosure document, characteristics and risks of standardized options. You can obtain a copy either through your broker or by contacting us at options@theocc.com, and someone on our investor services desk would be happy to send you a copy free of charge. And to simplify today's examples and computations, the commissions, fees, margin interest, and any taxes have not been included in our examples. And finally, any strategies discussed here today are strictly for illustrative and educational purposes and should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities on behalf of OIC. Okay, so who is the OIC? The OIC is the Options Industry Council. We are the leader in free and unbiased options education. We have no agenda other than providing you with best-in-class options education, which we do primarily through our website, optionseducation.org. There you'll find free online content, which will include videos, podcasts, and webinars, as well as option tools. The pride and joy of the OIC is our investor services desk, which has over 75 years of collective options-related experience. Our investor services desk can be reached at options@theocc.com, where you can submit any and all of your options-related questions. And you can also reach us through our online chat service, which is available Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. So the OIC, providing a free service to any and all, is funded by our parent company, the OCC, the Options Clearing Corporation. The Options Clearing Corporation is the world's largest equity derivatives clearing organization. Essentially, the OCC ensures that the obligations of the contracts we clear are fulfilled. So essentially, for every buyer, there's a seller, and every seller, there's a buyer. So if you're trading options contracts and your counterparty defaults, well, OCC would step in and fulfill the obligations of that seller. So this way, the options market can function seamlessly and smoothly. OCC provides central counterparty clearing and settlement to all of the 16 different options exchanges, and OCC also serves as the risk manager for the industry. So here we are looking at a snapshot of annual options volume from 1973 to the present. And options started trading in 1973 on the CBOE, Chicago Board of Options Exchange. Started out with 16 different stocks. They only traded call options. Put options weren't introduced until 1977. And since then, we've seen phenomenal growth in the industry. And particularly, you can look at the spike in 2011. Then, if you remember, we had the sovereign debt crisis, lots of volatility in the markets, lots of contracts trading, as well as a lot of volatility in 2018, where we cleared over 5 billion contracts, which was a record for OCC and the industry. So here are the options exchanges. These are the 5 main parent exchanges, which operate 16 different sub-exchanges, and OCC supports each and every one of them. This is essentially where your option orders are routed to and are executed. These are the entities that also decide which equities will get listed options and which strikes and expiration dates are available. So here's today's presentation outline. We are going to be talking about option pricing models. What are they and why do we use them? We'll get into put-call parity, the relationship between calls and puts with the same strike and same expiration. We'll do a discussion on arbitrage, synthetic options. We'll talk about reversals and conversions. And lastly, we'll finish up with a little talk about volatility pricing skew. So I wanted to mention that Q&A will be conducted along the way. My colleagues Mark Benzaquin and Bill Ryan are behind the scenes answering your questions live. If we can't get to any of your questions today, someone on our investor services team will reach out to you by the end of the week with an answer. Lastly, I encourage you to take our survey at the end of the presentation. We do read each and every one of your comments and suggestions, and your input helps shape our program going forward. So thank you in advance for your participation. All right, so let's get started. So essentially, who makes option prices? When you're looking at a option chain and you see a lot of blinking lights and different colors and multiple strikes and calls and puts, and you see all these crazy prices, like who is making all these prices? Well, essentially, it's the collective buying and selling of options by you, individual investors, by institutions, by money managers, banks, hedge funds, pension funds, as well as professional market makers. The NBBO, which is also known as the National Best Bid, Best Offer, is the consensus of the most competitive bids and offers in the marketplace at any given time. The options markets are no different than any other market, as prices are constantly trying to find an equilibrium. So what is an option ultimately worth? Well, that's a trickier question. An option is really only worth what somebody is willing to pay for it. So we will use option models as a guideline, as a tool to help us model and figure out a fair value for an option, but supply and demand can override that theoretical value or that fair value. So if we take an option model and we put all our inputs into it and say it's an XYZ D25 call, and our model says this call is worth $1. Well, if somebody's willing to pay $1.25 for that option, well, that option is no longer worth $1. It's really worth $1.25 at that point in time. So the model is only as good as the values that we put into it. So, like the old saying, garbage in, garbage out. So once again, they are tools. They help us in our pricing, modeling prices, but they certainly don't make the decisions for us. So once again, models being mathematical formulas that can be tools. They do remove the emotion from pricing, and at the same time, they don't make the executive investment decisions for us, okay? And markets are always subjected to the factors of supply and demand. So let's look at the inputs for a model. These are the main inputs for our pricing model. Essentially, there's our stock price, strike price, volatility, time to expiration, and the cost of money, the interest rates less any dividends. So each and every one of these inputs is known. It's a known input except for one. And that one component that is unknown is volatility. Volatility is the component that every option trader is trying to solve for. It's constantly changing, and it's what we're always chasing. Volatility, implied volatility, which is applied to options, is a forward-looking indicator. So it's just the market's idea of what volatility is going to be sometime in the future. So at any given point in time, we know the stock price, we know the strike price of the option that we want to pick. We will know the time of till expiration, depending on which option we choose to trade, and we know the cost of money. We know the interest rates at any given time and any dividends that stock's going to pay. Volatility is the wild card. So when we put all our parameters into a pricing model, what we're going to do is we're going to get an output. And that output is going to be call and put premiums, or otherwise known as theoretical values. So we put in inputs, we get outputs. Outputs are the theoretical values. So let's talk a little bit about pricing models. So the earliest and most widely known model is the Black-Scholes model. This model was formed in 1973, and it was created by Fisher Black and Myron Scholes, later improved upon by a gentleman named Robert Merton. So it's often called the BSM model or Black-Scholes-Merton model. Scholes and Merton actually won the Nobel Prize in Economics in 1997 for their work on this model. So here's the model itself. It's rather involved. I consider myself pretty decent in math, and looking at this model, it just makes my head hurt. But you know, I like to look at numbers, but when you start throwing in letters and coefficients and everything else, it gets a little crazy. Fortunately, you don't have to understand the math in order to use the pricing model, just as you don't need to understand how a combustion engine works in order to drive a car. So this is the earliest and most well-known, widely known model. It revolutionized options trading, but it certainly had some limitations. Those limitations, the biggest ones being that it did a great job modeling European-style options, in other words, options that can only be exercised at expiration, but it didn't take into account early exercise. So American options can be exercised at any point up until expiration. So, and why would somebody exercise an option early? Well, and one good reason is for a dividend. So the Black-Scholes model didn't really do a great job modeling dividend-paying stocks. It also assumed that volatility was constant. We know that volatility is not constant. Volatility is a living, breathing thing, and it's always changing. And so that was a limitation. A couple other limitations are it assumed that interest rates were constant. We know interest rates change all the time. Log normal distributions of returns. In other words, the Black-Scholes model did a good job of pricing at expiration. It didn't necessarily do a good job pricing all the time intervals before expiration. Once again, it assumed that no commissions or transaction costs were involved and that markets were efficient. So we know that while this is a great model, it didn't necessarily model American-style options as well. So we have variations of the Black-Scholes model or extensions of the Black-Scholes model. The most famous one is the Cox-Ross-Rubenstein model, which was formulated in 1979. This model did take into account early exercise and modeled for dividends a lot better than Black-Scholes. It's a binomial model, meaning that it breaks down the time to expiration into potentially a very large number of time intervals. And once again, the biggest advantage of the binomial model over Black-Scholes is that it can be used to accurately price American-style options. So you can take these models and you can do all the legwork and crunch the numbers and come up with theoretical values, or you can make life easy on yourself and you can use an options calculator. We actually have an options calculator on our website, and you can access it for free under Options, Quotes, and Calculators. So let's take a look at that calculator. So here we are. Here's the calculator, and it's pretty self-explanatory. If you need help with this calculator, you can always click the box in the upper right-hand corner. It says Calculators Help, and you'll get a very detailed syllabus that describes each and every input on here. It will describe the inputs as well as what you're seeing on the output side. But to use this calculator right off the bat, you can put in a stock symbol or an ETF symbol in the symbol box and hit calculate. And what it will do is it will take the current stock price, the current at-the-money strike price. It'll take the most recent expiration that the issue has. It'll take the volatility up based off of last night's, wherever volatility closed last night, and it'll put in the interest rate. And you can change any of these parameters at any given time that you wish. But in our example here, for this particular issue, we hit calculate and we came up with our theoretical value of $3.06 for the call and $2.80 for the put. And as you can see below the theoretical values, you have all the Greeks. You have your delta, your gamma, your theta, your vega, your rho. Really good information. We're not going to get into a deep dive on all the Greeks, but certainly that's something you want to brush up on if it's something you haven't studied before, because it's good to know how the Greeks impact option values. So in this case, based on all the parameters that we put over here on the left-hand side of the screen, our call value is worth 306. So now that doesn't necessarily mean that is where we can buy and sell that option. That's just a fair value. So I'm going to give you a little glimpse into how a market maker makes money. So let's assume that all the parameters that we put in are correct, okay? The stock price, strike price, volatility assumption, interest rates, yada, yada, yada. So if 306 is a fair value, a market maker might say, okay, well, if it's worth 306, I'll pay $3 for it, but at the same time, I'll sell it at 310. So in that instance, whether the market maker pays $3 or sells it for 310, theoretically, they're making money. So if the market maker paid $3 and it's worth 306, in theory, they're making 6 cents. And at the same time, if the market maker sold it for 310 and it's worth 306, they're going to make roughly 4 cents. So that's what's called a market maker's theoretical edge. And if you're trading hundreds, if not thousands of contracts on any given day, and you're buying on your bid, selling on your offer, and hedging with stock, you're gonna build this mountain of theoretical edge that, in theory, is your profit. And that's how a market maker makes money. So anyway, that's a little sidebar. Another way to use the calculator, which is kind of neat, is you can take the call or put in the box in the lower right-hand side, pick call or put, and you can actually put in a price. So for our theoretical value here at 306, modeled at a 20 volatility, we have a theoretical value of 306. We could put in a $4 price for that option and hit calculate, and we can figure out for volatility. So actually I did this when we were offline, and I came up with a value of, I think it was 26.43. So as you can see, you can put in the price and figure out the volatility for the option as well. So there's all kinds of neat ways you can use this calculator. I certainly recommend going on our website and playing around with it. It's certainly a useful tool. So now let's get into put call parity. Now we're going to get into the crux of the relationship between calls and puts that share the same strike and same expiration. There is this direct relationship between calls and puts and stock that is known as put-call parity. And knowing the value of a call, you can imply the value of a put and vice versa. So because of this relationship, it'll keep prices in check. So a simple way to think about this is calls and puts each have a delta. So stock itself, well, stock doesn't necessarily have a Greek, but if you were long 100 shares, as a trader, we would say, I'm long 100 deltas. And why is that? Well, if the stock goes up by $1, you're going to make $1. If the stock goes down by $1, you're going to lose $1. It's pretty simple. Options have deltas as well. So a call and a put, say the stock's right at 50, in theory, our 50 level call will have a delta of 50, and our put option will have a negative delta of 50, because obviously, calls have positive deltas, puts have negative deltas. So if I buy that call and I get long 50 deltas, I buy one of them, I get long 50 deltas, and at the same time I sell an at-the-money put, okay, I'm going to get long another 50 deltas, because if you remember from, elementary school math, a negative times a negative is a positive. So if I buy a call for 50 deltas, or at-the-money call, I get long 50 deltas. I sell the put, I get long 50 deltas. That's 100 deltas. So if I buy the at-the-money, or if I buy a call and I sell a put the same strike, I'm going to be long roughly 100 deltas for every time I do it, for every one contract I do. If I do it once, I'm going to be long 100 deltas. So there's this unique relationship between calls and puts. Also, you can infer the delta of one by knowing the other. So let's say we're looking at a call and it's got a, say it's a, it's a 50 level call, and say it's got a 70 delta. Well, by knowing that, we can infer that the 50 level put is going to have a 30 delta, because 70 plus 30 is 100, okay? They have to be roughly close to 100 to keep this put call parity in line. If we have an out-of-the-money call that's trading for a 25 delta, well, intuitively we can infer that the corresponding put will have a 75 delta to keep the relationship in line. So now let's look at arbitrage. So this put call parity keeps markets in line, but let's see what happens when markets aren't in line. So essentially, arbitrage is the simultaneous buying and selling of financial assets that in the same underlying to take advantage of differing prices. So in a very simple sense, we're going to look at two markets. In market A, we're selling apples for $1, and market B, the same apples are selling for $1.50. Well, here we have an arbitrage, because we can buy apples in market A for $1 and sell them in market B for $1.50 and make a risk-free 50-cent profit. Now, who wouldn't do that? You're going to do that all day. Well, that's only going to last so long, because what's going to happen is, as the market gets wise to this, it's going to bid up the price of apples in market A, and it's going to sell down the price of apples in market B. So say at a certain point, apples in market A will get bid up to, say, $1.25. In market B, apples will get sold down from $1.50 down to $1.25. At $1.25, the arbitrage is gone. Apples are the same price in both markets. They're $1.25 in market A, they're $1.25 in market B, and the arbitrage opportunity has disappeared. So put call parity keeps the prices of options aligned and in line. If for whatever reason, and this sometimes happens, option prices do get out of line, these days with the advent of high-frequency trading, computers, algorithms, those arbitrage opportunities disappear as quickly as they appear. And computers will buy and sell the options and put that relationship back in line. So very rarely will you ever see one of these opportunities, but just so you know that how the pricing works for this. So now let's look at an example. So here's an example where we have a market where the put call parity is in line. We have a stock price that is trading for $49. We have our call price, roughly an at-the-money call, trading for $1, and our put is trading for $2. So as we were talking about earlier, the difference here is the same because we could buy stock for $49, say we buy 100 shares for $49, or we could buy the stock synthetically. We could buy 150 strike call for $1 and sell 150 strike put for $2. Okay, we're going to take in $1 credit, so that $1 credit plus the strike gets us to $49. So the P&L characteristics are going to be very similar between trading stock for $49 or buying the 50 call for $1 and selling the 50 put for $2. Okay, it's going to have similar P&L characteristics. And if you think about it, it makes sense. If come expiration, if the stock is trading 50, we're going to exercise our 50 call and be long 100 shares of stock. And if stock is trading at 45 come expiration, we're going to get assigned on our 50 put and we're going to get long 100 shares of stock. So either way, it doesn't matter where the stock is, we're going to get long 100 shares at $49. Okay? So now let's look at a different example. So here we have an example where the stock is trading for $49.50, but the option prices haven't changed. Now we have an arbitrage. Just like in our Apple example, we have the calls trading for $1 and the puts trading for $2. So if we bought the call for $1 and sold the put for $2, that would get us long synthetic stock at $49. But now we can sell real stock for $49.50. So we can lock in a risk-free 50-cent profit. And that's what's exactly going to happen. The market is going to bid up the prices of the 50 calls to a point where the market is back in equilibrium, and they're going to sell the 50 puts down. And at a certain price for those options, the market will be at parity and equilibrium. So let's say the 50 calls traders will bid them up from $1 up to $1.25. And they'll sell the 50 put from $2 down to $1.75. So $1.25 we'll pay. We'll take in $1.75 for the put. That's a 50-cent credit now. You add the 50-cent credit to our 50 strike, and we get to $49.50. Now the market is back in line. Once again, the forces of supply and demand are putting our option prices back in line and eliminating the arbitrage and restoring an equilibrium. So now because we have this unique relationship between calls and puts, we can actually turn one into the other using stock. So if we have a put option, we can turn it into a synthetic call, and if we have a call option, we can turn it into synthetic put, and we're going to show you that in the next couple slides. But just like we were talking earlier about puts or calls, calls or puts, we're going to show you how that works. So these two strategies, one's called a conversion and one's called a reversal. And a conversion simply, using our examples before, a conversion is simply the purchase of long stock. So in our example here, we're going to buy 100 shares at 50, and we're going to sell synthetic stock. So we're going to buy one DEES 50 put, and we're going to sell one DEES 50 call. So we're long real stock, and we're short synthetic stock. That position is called a conversion. Okay? So if the stock goes to 100, we don't make or lose money because we're long stock and short stock. Stock goes to 0, we don't make or lose money because we're long stock and we're short stock. We don't benefit from a directional move. This is where a completely market neutral move. The only real people that can take advantage of these type of strategies are professional market makers, people that have the ability to buy on their bid and sell on their offer and quickly sell stock and lock in small little profits. And I'll tell you, even today with the advent of high frequency trading and lightning fast markets, very rarely do these strategies or these opportunities exist. I mean, people can still put them on, but it happens less and less. So in the example of the conversion, the risk factors are a hike in rates and a decrease in the elimination of dividends. And why is that? Well, if we're long stock and short synthetic stock, any hike in interest rates, say we're long stock in a margin account, well, we're going to have to pay a higher rate to margin our long shares. And plus, we are counting on a dividend as part of our P&L. So if a decrease or an elimination of dividend happens, a conversion would suffer. So just the opposite, the reverse conversion or reversal is simply the sale of real shares, 100 shares at 50, and the purchase of 100 shares synthetically, buying one DC50 call and selling one DC50 put. So in this example, we are long synthetic stock and short real stock. And the risk factors here are just the opposite, a drop in interest rates and the addition of or increase in dividends. So why would a drop in interest rates impact this position? Well, short sellers receive short interest when they borrow the shares and they sell them short. They can put that money into an account at a clearing firm, and the clearing firm will pay you a small amount of interest on carrying those short shares. A drop in interest rates will impact that negatively. You'll get less money by being short shares. Additionally, if a dividend is increased or added, you owe that to the person you borrowed the shares from. So once again, people who are long stock receive dividends. People who are net short the stock have to give those dividends or pay the long holder for those dividends. So that would be a risk factor there. I remember when I was trading options on the CBOE, and we were trading back then in fractions. Now we trade in decimals. But when we were trading in fractions, the markets were wider than they are today. So it was quite possible that traders could leg into these reversals and conversions and actually make money. So I'll give you a perfect example. So say I'm in the pit in the morning and somebody buys one DC50 call from me, and I sell it and I buy 50 shares to hedge it. And then half an hour later, somebody sells me the DC50 put, and I buy 50 shares to hedge it, and now I'm perfectly hedged, and I've got the conversion on. So I've sold calls on my offer, I bought puts on my bid, and I bought 100 shares of stock. I probably made a very small profit. And when you're trading thousands of contracts during the day, throughout the day, you might be legging into a conversion or a reversal. These aren't strategies you're really going to be able to put on as individual investors, but you have to understand, the dynamics of the pricing, and that the pricing, the put call parity affects how these conversions and reversals are priced. So at one point in time in the 90s, there was actual desks that were devoted exclusively to putting on conversions and reversals and trying to take advantage of mispricing in the market. Those desks no longer exist due to the fact that markets are tighter and there's high frequency trading. Those profit centers no longer exist like they used to. So here we are. This is probably the most important slide on the deck. This is going to break down the original position versus the synthetic position. And we've already talked about synthetic long stock and synthetic short stock, but now we're going to talk about the individual synthetics. So once again, if with stock, there's only two things you can do. You can either be long the stock or short the stock. With calls, there's only two things you can do. You can be long the calls or short the calls. Sorry about that. With puts, there's only two things you can do. You can either be long the put or short the put. So by combining all of these different scenarios, you can create calls out of puts and puts out of calls, and I'm going to show you how this works. So we already talked about long stock. Long stock, the synthetic equivalent is long a call, short a put, same strike, same expiration. Okay, if I buy one call and short one put, that's the same thing as being long 100 shares of stock. On the flip side, synthetic short stock or short stock, the synthetic equivalent is long one put and short one call, same strike, same expiration. Now a long call. A long call synthetic is the same thing as being long stock and long a put. So why is that? Well, if I buy, and this is actually probably a position that many of you have put on in the past, you're long shares in a company and maybe you want to buy a downside put as protection against it. So let's say we buy shares at $50 and we're worried about a bigger than 10% move, and we'll buy a 45 put for $1. So now what do we want? We paid $1 for the put, but we ideally want the stock to go up, okay? Buying stock for $50 and buying a 45 put for $1 is the same thing as buying the 45 call for $6, okay? Because it's the difference in strike between the stock price, the strike price, plus the premium that you paid. $5 difference between 50 and 45, you paid $1 for the put. That, it's going to, your long stock and long put position, P&L wise, is going to look very similar to a long 45 level call. A short call position is going to be the synthetic equivalent of shorting 100 shares of stock and shorting one put. A long put position is going to be the equivalent of selling 100 shares of stock and buying one call. And finally, the short put position is going to be the same as long stock, long 100 shares of stock, and short one call. Now, I'm not going to go through diagrams for each and every one of these, but we will look at the very last one because, as you can see, that's one of the most common positions that investors put on, long stock and short calls, also known as a covered call or buy right. People put on these positions where they're long calls, they're long stock, and they sell out of the money calls against their long stock to, one, create a little income. You know, they're neutral to moderately bullish, so they don't want the stock to rip, but at the same time they want, you know, the stock to appreciate a little. At the same time, they want the call to expire worthless. If that happens, they create a little yield. At the same time, they lower the entry price or their cost basis on the long stock. Okay, so. And ideally, if you just want to get your calls to go out worthless and you keep rolling and you sell more calls, and the more calls that go out worthless, the lower and lower your cost basis on the long stock. So now we're going to take a look at why a buy right or a covered call position is the same thing as a short put. So here's our position. This is simply buying stock at 54.5, okay? If stock above 54.5, we make money. Stock goes to 60, we're dancing. If stock goes to 50, we're not. So obviously pretty simple. Stock goes up, we make money. Stock goes down, we lose money. Now we're going to introduce, taking the same position, we're going to be long stock from 54.5, and we're going to add a short 55 call for $1, okay? So we took in $1 to sell the 55 call. So that caps our gains at 56, right? The strike price plus $1, it's 56. So our profit is capped at 56. So the difference between 54.5 and 56 is $1.50. This stock goes to 100. The most we can make on this position is $1.50 to the upside. Likewise, on the downside, we've taken $1 for the call, so originally we purchased our shares for 54.5, and we took in $1 for the call, so that lowers our cost basis down to 53.5, and that's our new break-even point. But below 53.5, we're going to lose dollar for dollar on the stock. So, we really want those shares to ideally go to 55. Where our call goes out worthless, our call doesn't get assigned, we don't get assigned on the call, and we're still on the stock, and then we can continue to roll calls. So, but as you can see, our break even is now 53.5 on the downside. The most we can make is $1.50 on the upside. So now let's look at a short 55 put. The P&L is identical, okay? And why is it identical? So it's identical because if we're just naked short the 55 put, stock goes to 100, well, we're going to make $1.50, just like in our covered call example. We will keep the $1.50. Since we took in $1.50, our break even on the 55 put is 53.5. As you can see, 55 minus $1.50 is 53.5. Below 53.5, we will lose on our short put. So as you can see, the P&L characteristics are identical. Okay, so whether you do covered calls or sell the put outright naked, it's the same P&L. So if next time you're at a cocktail party and somebody's asking you what kind of investment strategies you like doing, and if you're a person who likes writing covered calls, you can just as well tell them that you like selling in the money naked puts, because that's exactly what you're doing. So I just want to let you know that that's the P&L is identical. So now, lastly, we're going to talk about volatility pricing skew and how it affects option prices. So, and we can't talk about volatility skew until we talk about volatility really quick. So there's two types of volatility. There's historic volatility and there's implied volatility. Historic volatility, we say, is backward looking because it's looking at the movement of the underlying in the past, okay, how volatile the stock has been in the past, while implied volatility is forward looking, okay? It's the market's estimate of future volatility as implied from the options price. So stock itself doesn't have implied volatility. Only options can have implied volatility. So, and once again, we're always trying to, as options traders, figure out implied volatility, okay, and it's a moving target. So traditionally, pricing models assume that implied volatility for options with the same expiration, the same underlying should have the same implied volatility, okay, and that out-of-the-money calls and out-of-the-money puts would have similar prices. Well, we know this isn't the case. So prior to the crash of 1987, there was really no skew priced into the options market, okay? There wasn't the tail risk wasn't necessarily there. And then in 1987, the market crashed 22.6%. And all of a sudden, the market woke up to the fact that, oh my God, stocks and indexes go down a lot faster than they go up. And ever since 1987, in most products, you will see this natural volatility skew where the out-of-the-money puts are trading at a higher volatility or a higher price than the out-of-the-money calls. And when you think about it, it actually, pricing-wise, it makes sense. So think about the market. Most people in the market are just net long the market all the time, whether it's individual investors in their brokerage accounts or 401ks or pension funds. The majority, other than short sellers and some hedge funds, the majority of the market is just net long. So if you don't want to be long, how can you hedge? Well, you could sell all your stocks, but then you'd have no downside, but you'd also have no upside. So theoretically, the only way to hedge is to either buy puts or sell calls or do both. Well, based on supply and demand, what's that going to do to the pricing? Well, there's going to be a demand for puts and there's going to be a supply for calls. So because of that, there's this skew built into the pricing where the downside puts are more expensive than the out-of-the-money calls. So if you look on a traditional index or most stocks, if you look at the 10 or 15% out-of-the-money puts, they're going to be trading at a higher level than the 10% or 15% out-of-the-money calls. And this makes sense. So here we've got two volatility graphs, one on the left that shows the weighting that's equal on the out-of-the-money strikes, so the out-of-the-money puts and the out-of-the-money calls have equal weighting, but more realistically, we have the skew, which is built into the market that we see on the right-hand side, where we see the downside or tail risk is priced higher than the out-of-the-money upside risk. Okay, so in the majority of products, this is the skew you're going to see. You're going to see the downside, the tail risk is priced higher than the upside. Doesn't mean that the markets are going to go down, but that's where the market is pricing the risk, okay, the gap risk, so to speak. There are instances where this is actually violated, where the skews are completely backwards. Where might this happen? Well, certainly some volatility products such as the VIX. You'll see an inverted skew where the upside is more expensive than the downside. Quite often you'll also see a reverse skew in commodities such as gold and some other commodities. You will also see inverted skews in, say, maybe a biotech. Say a biotech's got a big FDA announcement coming up and the market's pricing in a greater upside move than a downside move. In such instance, you might see a reverse skew where the out-of-the-money calls or the gap risk is to the upside rather than the downside, and the out-of-the-money calls are going to be trading at a higher premium than the out-of-the-money puts. More often than not, traditionally, the skew is to the downside in the majority of products, but that backward skew sometimes does exist. Well, it does exist, it just exists in certain products. I can certainly tell you from personal experience trading in the 90s, when I started trading on the SIBO, was right at the beginning of the internet bubble, and anything with a .com at the end of it was just on fire. And at the time, it seemed that there was the sky was the limit on how high some of these stocks could go. And literally investors would come in and they would sell us out-of-the-money puts in order to purchase their out-of-the-money calls. And because of that, a lot of those internet stocks that are no longer around now had reverse skews where the upside was hugely bid for and the downside puts were used to finance their out-of-the-money calls. And, well, we all know how the internet bubble happened and how it played out. So, but just to let you know, that skew is essentially telling you where the gap risk is and where the market is pricing that gap risk. So in finishing, essentially some things to know, things to keep in mind. Option pricing is set by the markets due to the supply and demand for options. And once again, like the models are great. They can be used as tools, but they don't ultimately determine the price. It's the supply and demand and the market for options that determines the price. Once again, put-call parity is a relationship between calls and put prices at the same strike, same expiration. And due to this unique relationship, we can accomplish the same risk-reward profiles with synthetics as we can with standardized positions. So that is our presentation today. Looks like we have a couple questions or one question. One of the questions is there an instance where an individual investor might wish to trade a conversion or reversal? That's actually a good question, and I wasn't going to get into it, but I will tell you there are times when a trader might want to trade a reversal and conversion, and this is going to get, this might get a little complicated, but essentially in situations where stock is hard to borrow, meaning that the borrow for the stock is everybody in the world is trying to short this stock. So in order to short a stock, you have to go out and you have to borrow from somebody who's long. But in some stock where there's a lot of short sellers in the stock and everybody for whatever reason is trying to sell these shares, if it's unborrowable and you can't borrow the shares, well, how are you going to get long the shares? Well, traders will sometimes do conversions and they'll pay a price to do the conversion in order to get long stock to avoid a buy-in. And a buy-in is when, if you're short the stock, the long holder wants his shares back and decides to sell them in the open market, well, he's buying you in. Okay, you just can't stay short the stock. So there is when you're short stock, there is this buy-in risk. So to alleviate the buy-in risk, many traders will sometimes execute conversions in order to get long stock, or as traders call it, long bullets. So there is an instance that's a good example of when somebody might trade one. But in general, you're not going to be able to look at an options chain and realistically, buy the call, sell the put, and sell stock and lock in a profit. And if you see a market that's out of line and you're like, oh, I can do this conversion for a $2 credit, well, you need to stop and ask yourself why that is. And it's probably because the stock is hard to borrow, and you need to do a little homework before you put that on. So let's see. I think there's another couple questions here. can you talk a bit more about the options calculator and the Greek outputs? How accurate these numbers? If a call option has a delta of 75, is it guaranteed to move 75 cents on the dollar? Well, essentially, if the option has a delta of 75, in theory, if the stock goes up $1, your option should make 75 cents. And in theory, if the stock drops $1, your option, say it's a call option, will lose 75 cents. Is that always the case? Well, no. So what if you have an option and you're long the option, which means you're long, say you're long a call option. So you're long delta, you're long gamma, you're long vega. Well, all of a sudden, what if volatility gets hammered? It just gets crushed. Well, that option might be worth less. And because of that, if the stock might be up $1, but that option might be up only, it might not be up 75 cents. Maybe it's up 40 cents, okay? So when you're long options, you have implied volatility that can be working for or against you. Obviously, if you're long the option, you want implied volatility to go higher, but there are instances when implied volatility can go lower. So just keep in mind the delta of options isn't it's just it's a barometer, but sometimes other things can offset that. Just keep that in mind. So essentially, I think that is, as far as questions, I think that's the end of our questions. You can thank you for attending today's webinar. We appreciate your support. You can please join us on December 4th as OIC presents Dan Passarelli, and he'll be discussing volatility analysis for options investors. Also, if you are in the Chicago area on Saturday, December 14th, you can sign up for our 3-part live in-person presentation on options pricing, which will also be simulcast online for those who choose to attend remotely. For more information, you can reach out to us through our website or by sending us an email at options@theocc.com. Please also check out our OIC YouTube page, where we have archived many of our past webinars and video content, and also be sure to follow us on Facebook and Twitter. So just to let everybody know, as you signed up for this event, you will get a link in the next 24 hours at some time tomorrow that will allow you to revisit this webinar at any time you want. Up in the upper right-hand corner of your page, they're under resources. I believe that you can download the PDF and have the deck for your records as well. And please reach out to us with any and all of your options-related questions. So once again, I thank you for your time. We look forward to seeing you at the next webinar, and have a great day, everyone. Thank you very much.